Hey, good afternoon, everybody. Chris Lester here. So, if you're new to this call, have not been on this call, we do this every week, Thursday at 4:30, and it goes for about 15 to 30 minutes, depending on the content. And we try and touch base on the relative factors that help you to have a deeper understanding of things that are current, happening in the economy or socially, or that we should be thinking about for long-term planning. So every month I've been doing sort of a laggard approach of the month that we've just passed and then a year to date of the economy. So this will be our August market update, which is actually for the month of July, ending July 31st. That being said, we're going to go ahead and get started. So the market update. Some of you may recognize these charts, and to sort of give you a precursor of what to expect. First, we're going to look at growth markets, right? It'll be a snapshot in time of some different asset classes and indices for the month of July. And then the next slide will be for the same growth markets, but year to date. And then we have a bull bear indicator that sort of shows, since we've been tracking some technical indicators that we use to sort of just keep a pulse on the market of what do we see, what's happened recently, and where do we see things going here in the future. And then we will turn around and do the same thing for income generating type assets. So, both, for the month of July and then year to date, and then a bull bear market indicator. And then lastly, we have a proprietary indicator that sort of just tells us, do we think we're heading into a recession? You can see here on this growth market for the month of July, July has actually been a positive month across all indices. You can see from left to right that everything finished in a positive. That being said, one of the ones that is pretty surprising, because even though gold is showing up on this indice, and this is the gold ETF, right, is up over 10%. And gold is typically an asset class that is a flight to safety. So when investors are uncertain where to put their money, quite often they will move to gold. So you can see there that up over 10%. And then immediately below that is emerging markets, right? So emerging markets, typically this is going to be China. China is considered an emerging market. And so their equities have started their recovery from Corona, have done well for this month. And overall, you'll see why on the next slide. A little bit further down is the red line. The red line is the S&P. And the S&P is an index that's used to measure large caps here in the United States. And you have to remember that that indice is capitalization weighted. So what does that mean? That means that if you have more money, you're going to carry more weight on how the economy is doing. What's interesting is right now that the S&P is being carried by probably 5 or 6 technical stock companies. So Amazon, Facebook, Google, Microsoft, these types of companies are actually carrying the lion's share of the S&P through these uncertain economic times. But again, it had a healthy month, up over 5%. The next one down is the black, and I guess a light blue line. Black is real estate, or REITs, real estate investment trust. And so the real estate investment trust, you can see, have done 3.5%. And then the blue line there, those are commodities. And we're going to see on the next slide, it makes sense that they at least have no choice but to recover something. So, and then lastly is the developed countries, that green line. So overall, from left to right, July was a good month, right? And you're seeing now that the economy seems to be improving. You'll hear on the markets, on the news channels that, oh, we're at all-time highs. And I caution, because that's only partially true. So as we look at a year to date, something again that just jumps off the chart at me is that gold is up over 25% for the year. So that is typically an asset class that investors go to as a flight to safety. So golds are approaching highs that haven't been seen since 2011, right? Now, the red line is, again, the S&P 500. So as much as the news channels will tell you that, hey, listen, we're at all-time highs, the worst is behind us, you have to look at that and go, we've just entered into positive territory for the S&P. And remember, that is being carried by 5 stocks in the technical sector. And the NASDAQ, same thing, all-time highs. We're at all-time highs with those same stocks. So to me, it's still a little bit of caution. Don't look at your portfolio and go, why isn't my portfolio necessarily grown? Because it's a broad spectrum of asset classes. Not everything has recovered, because as you can see, the next 3 or 4 indices, right? So we got the emerging markets, right, which are China again, is just about out of negative territory, but it's still negative. And then again, we have the developed countries, right, are still down around 10%, with the blue line being small caps. So you have quite a bit of different sectors still in negative territory. So when everybody's telling you that the market is fine, I look at this and go, you know what, maybe not so much. And then all the way at the bottom is commodities, down almost at 50% at one point, and now down 35%. So overall, it is good news, right? That we do seem to be in an upward trend. But I just want to caution that there still is uncertainty out there. We have an election coming up. We have COVID falls upon us. So you're going to see here in the next chart, if you remember, this is what we call our bull bear indicator. Now this indicator, there's a lot going on here, but it's really a pretty simple indicator, and it's not, by no means an end all be all, but it's an indicator that was developed by the firm that I work with, and it really is just helping us to keep a pulse on it. So the top sector here, it's called the Relative Strength Index, RSI. And then next, we have what is called your MA, your Moving Average Crossover. And then the last indicator down here is called MACD, Moving Average Convergence Divergence. So what happens is, and the way this works is, if all 3 indicators go negative, it will create a red line like there in, just towards the end of 2000, 2001. And then if all indicators go positive, they will turn a green line. So you can see we've had a red line in 2000, at the end of 2000, then again right towards the end of 2006, and then again around 2008, we had some red lines. And then you see again, we had some green lines. And good news is, since March, we had a red line, right? And that was cause for concern, and that makes sense because we had a huge sell-off, and actually it was one of the greatest sell-offs in history, right? So it went down very, very quickly. But remember, we talked about sometimes you can get head fakes, and so the economy and the stimulus and the packages that were entered, and the Fed keeping the borrowing rates down around 0 have helped the economy right now to be able to get their feet back under itself and have allowed the recovery that we're seeing now. All 3 indicators have now gone positive by the end of July 31st. So that is good news, which means that forecast-wise, that things should be in a positive trend going forward. But it's not a guarantee, but it is a positive sign. So winds are in our favor right now is how we would like to describe that. So now as we look at the income markets, right? So you're going to see there, this is a different area. Asset classes are things like high yield bonds. That's your dark blue line all the way at the top. And that makes sense because high yield corporate bonds have been getting beaten up of late. So for the month of July, they had a chance to recover because, again, we're seeing optimism in the marketplace. And again, all income type generating indices have actually, we had a positive month there in the month of July. But what I find interesting is very similarly, immediately under that is that light blue line. And those are 20-year treasuries. So on the one hand, you have folks with a flight to safety in the growth markets into gold. And then on the income side, you see a flight to safety in the form of treasuries. But now we're also seeing that, people are looking for a little bit of yield as well. So the reason the market has done well for the treasuries, we'll get into that, is because bonds have an inverse relationship to yields. And if the yields are falling, the prices go up, right? So if interest rates are dropping, you're going to see your prices of your bonds go up and vice versa. So right now, because interest rates have been so low, bonds have been so high and the values have held up. But now we go a little bit further down and you see that high yield muni bonds are right around a little less than 2.5%. Now, high yield munis have gotten the snot kicked out of them at the beginning of the year. So it makes sense that they have a good month. And then the next two indices, right? We have your normal munis, right? And then you have the US Aggregate Bond Index in red. So black and red there is right around a little under 1.5%. And then we have our international bonds. And then we have our intermediate treasuries in green. Now, you see a disparity between long-term and a little bit shorter term treasuries on the monthly. But if we go and we look at the year to date, we can see it's the flight to safety, which is the long-term bonds, 20-year bonds, and then even the 7 to 10-year bonds are leading the way year to date. Now, the aggregate bond index, right? So the US is just over 5%. So the US high grade bonds have done okay year to date, but then just over 0%, we'll say 3 or 4% are those munis and the international bonds. So they've done okay, but the high yield corporates and the high yield munis, when you hear high yield, think of junk bonds, right? These are the ones, I mean, there's a reason they're paying above average returns, and that's because their credit default risk is higher. So when we see, and you can see that the high yield munis were almost down 30% in March, right? 35%. So they've clawed their way back, and now the high yield corporates and then the high yield munis are down around 5%, but the high yield corporates are just around 0%. So as a whole, you can see people are looking to fix index come, but they're looking for yield. They're looking for some type of revenue, but across different indices. And so we're watching this, and then we have our bull and bear indicators, right? So it's the same indicator. And, so again, if we have three negatives on the RSI or on the MA or on the MACD, if the three of them turn negative, it'll be a red line. But you can see that since the beginning of 2019, we've been on an upward trend. We've had a green line. And so bonds have done okay as an overall valuation standpoint, as a holding their price standpoint. Now, yield has been a little bit of a challenge, right? So if you're counting on that revenue to live on, that's where it can be a challenge, because yield is obviously starting to drop as longer term bonds are maturing and investors are looking for places to put their money to maintain the yield. So that is the crux of the issue, and we will continue to monitor. But overall, July was a good month. Overall, things have been good both in the growth sector, the equity sector, and in the income sector. So the last slide before I end it, and this is a unique proprietary indicator. This is a recession probability analytics, RPA, was designed by my RIA. And really what they've done is taken a lot of factors from the economy. I mean, just a number, unemployment, manufacturing, just a lot of things that they run through a series of metrics to come up with one number. And then basically, if that number is above the 50, that means that the forecast is that a recession is probable. And you can remember over the last couple of months that we crossed over into this recession type environment. And then if it's under 50, that means that, hey, things look better into the horizon. So with that said, we have just crossed back down below the 50 line. We're now at 46.89 versus 57.46. And, the range is usually going to be between 80 and 20, but that is good news that we've dropped below the 50 percentile. Now, that being said, does not mean that everything is clear sailing going forward. We do see positive signs, but there are still some unknown facts and variables, right? So again, we see a lot of political unrest. We see an election on the horizon. We have COVID. However, with COVID, one of the things that the market is really, really excited about, there seems to be, and they're hopefully optimistic, that a vaccine seems to be on the horizon, right? And on the near horizon. And that's what's also carrying a lot of the market optimism going forward. So I'm going to encourage everybody, again, temper the information that you from the talking heads. That's why I like to look at this from a month ago, right? So if we looked at the news today, you'd think that everything was going to be fine and rosy, all-time highs, people are high-fiving. But when we do this here in September and we look at August, We don't know what the environment, we're going to be much closer to the election, but August will have been probably one of the, I think, pillars in projecting what our future economic outlook is going to be. So with that, folks, I appreciate everybody that's on this call. Hopefully I'm providing value to you. If you have any questions on the slides that were presented today, please either reach out to me. If you know me personally, always happy to speak with you. If the person that invited you on the call was an advisor elsewhere, then I'm going to ask you to circle back with them and touch base with them and just